Guys, the US-Iran conflict is creating a once-in-a-lifetime setup for Wall Street and any investors paying attention. So the US just launched the largest military operation in the Middle East since the 2003 invasion of Iraq. Now, the only thing before we dive in return for all the work that goes into making a video like this, is that you hit that like button and don't forget to subscribe. Every time you do that, YouTube pushes this video out to more people, which helps us prepare more people for what's happening. Here's the dirty truth that nobody wants to talk about. Every time there's a major military conflict involving the US, Wall Street uses it to make more money. And almost every single time, everyday people and everyday investors are the ones that get hurt, and there's the ones that pay for it. This game's been run time and time again, and once you see what's happening, you can't unsee it. Now, one of the most respected voices on Wall Street, Tom Lee, was just on camera saying this has all the hallmarks of creating some good opportunities and that investors need to look beyond the headlines. Maybe think 3 months forward. He's essentially calling a market bottom in real time. And when Tom Lee says that kind of thing publicly, you pay attention because his track record speaks for itself. He specifically pointed to software in the Mag 7 is where the leadership is going to come from on the other side of this. So keep that in the back of your mind as we go through all this because it's going to become very relevant. In today's video, we're going to break down 3 things. Number 1, what history says happens to stocks during massive outbreaks of conflict involving the US. Number 2, how Wall Street has in the past and is now again positioning to take advantage of this. And 3, how to use this information to both protect yourself and also hopefully come out way ahead. Now, the US is currently carrying more than $38 trillion in debt. And the truth is, by every historical precedent, the current system should already be under extreme stress. Yet the US continues operating as if nothing's wrong, and financial markets just keep pushing higher for the most part, while the real economy is deteriorating. In times like these, the best way to secure and maintain your retirement is to maintain a balanced portfolio that can ride through the economic chaos. And with that in mind, I developed a list of the best 6 stocks to own in 2026 that you can download for free at stockscommunity.com/free. Now let's get into the pattern because this is the part that most people miss entirely. So step 1, here's the pattern. Conflict breaks out. Headlines are terrifying. Cable news goes 24/7 with war coverage. Social media lights up with people saying the world is ending. Crazy videos on X. Step 2, retail investors panic. They sell their stocks. They go all cash. They think they're being smart and protecting themselves. Step 3, Wall Street, the institution, the hedge funds, the smart money, buys what retail is selling at a massive discount because they've studied the data and they know exactly what happens next. Step 4, markets recover, usually faster than anyone expects, and all those retail investors who sold are now sitting in cash watching the market rip higher without them, too scared to buy back in. This isn't a conspiracy theory. This is documented. This is just what happens again and again and again. But don't take my word for it. Let's go through the actual data. Go back to June 2025, the Israel-Iran war, Operation Rising Lion. This literally just happened like 8 months ago. Israel launches strikes on Iran's nuclear facilities. US gets involved. Iran retaliated with missile strikes across the region. On the day Israel attacked, the S&P 500 dropped about 1%. NASDAQ fell over 1%. Oil spiked sharply. Retail investors flooded social media with posts about going all cash and calling it World War III. But here's what Wall Street actually did during that time. They bought the dip. Following Monday, just 3 days later, the S&P had recovered almost all of its losses. The Dow closed up. The S&P closed up. NASDAQ surged. Oil gave back its gains and fell below where it started. 12-day war ended and markets moved back like nothing had happened. Now go back to October 2023, the Hamas-Israel conflict. On October 7th, Hamas launched the deadliest attack on Israel in its history. Markets feared an all-out regional war pulling in Iran, the US, and every major power in the Middle East. Headlines everywhere said, sell stocks now, and yet the S&P 500 is up massively since that day. And if you look at Israel's own stock market, a country that's almost always at war, the MSCI Israel Index is up over 100% since that October 7th attack. It's roughly a 37% annualized return. Active conflict, based on the data, actually makes the case that you want to hold more assets, not fewer. Going into cash when you have escalating conflict is a recipe for disaster because governments devalue cash even further when they have to spend more money to fight their way out of these situations. Now go back to 2003, the Iraq War. In January 2003, as war became inevitable, stocks started selling off. The S&P dropped nearly 10% by mid-March. Retail investors were terrified, and the phrase, don't invest during wartime, was everywhere. And what did Wall Street do? They started buying because they understood something retail didn't. The uncertainty of war is worse for markets than the war itself. So let me say that again. The uncertainty of war is worse for markets than the war itself. When the uncertainty resolves, stocks go back up. When Baghdad fell in April, the S&P had already recovered all of its losses and was up over 8% from the March low. By year end, the S&P was up over 26%. The gain from that March low to December was nearly 40%. The institutional money that bought while retail was selling made a fortune. All the way back to September 2001. I mean, the most devastating attack on American soil in modern history. Markets closed for days, and they reopened. The S&P dropped nearly 12%. Genuine, justified fear, with about as much uncertainty as you could possibly get. And yet, even after that historic shock, the market had fully recovered within roughly 31 trading days. And since September 2001, the S&P has risen roughly fourfold. A study analyzing 29 geopolitical crises dating back to World War I found that stocks were higher 3 months after the shock, about 66% of the time. And the longer you waited, the more likely you were to be positive. The worst thing you can do is sell first and ask questions later. That's exactly what Wall Street is counting on you doing. Retail investors, going all cash right now, thinking to protect themselves, are actually doing the exact opposite. And they're rotating out of great assets into something that's guaranteed to lose value over time. So now I want to talk about where Wall Street tends to position during moments like this. There's three major lanes. Number one, defense and aerospace. This is Wall Street's bread and butter during military conflict. We actually talked about a drone stock in the six-figure strategy call on Monday. The flows have been building weeks before the bombs even dropped. The iShares U.S. Aerospace and Defense ETF has already gained roughly 14% year to date. The major defense names are all up between 10 and 15%. And depending on how long this conflict escalates, there may be a little more runway left, but a lot of that trade's already been tapped. Number two is energy, the chokehold trade. Iran produces over 3 million barrels of crude oil per day, roughly 3% of global production. And they're the fourth largest producer in OPEC. The bigger story isn't Iran's production, it's the Strait of Hormuz. The Strait of Hormuz is the narrow choke point between Iran and the Arabian Peninsula. So about 26% of the world's oil supply flows through that one waterway. And reports indicate that Iran's effectively closed the strait to commercial shipping. Multiple oil majors and trading houses have already suspended shipments. Until this is resolved, that means enormous upward pressure on energy. It means inflation goes up, and it means the Fed may not be able to cut rates as fast as it wants. So there's a technical analyst who was recently on camera earlier saying that when missiles fly, it's time to buy. He was watching the energy stocks relative to oil as a key signal, and this is what he noted. He said that the crude was up about 8%, but the energy stock ETF was unable to take out its prior high, and that kind of divergence is exactly the kind of signal that smart money looks at. Professor from Wharton also reminded everyone in the past couple of days that historically wartime is not always a bad time for markets. He pointed out all the way back to World War I when the New York Stock Exchange closed for 6 months, and when it reopened, stocks surged to new highs. Number three, safe havens. There's always been a flight to safety in global conflict. Treasuries, gold, silver, precious metals, and commodities. Gold's trading at record levels right now, had a slight dip. But central banks globally have been buying at a pace not seen in decades. Copper has been officially designated a critical mineral by the US government. These are all real and meaningful moves. However, there's an area I think is more exciting and way more useful for you long-term, high-quality tech and growth stocks. While everyone's missing the narrative plays like defense, energy, and safe havens, the high-quality tech and growth stocks that have already been decimated over the last 4 months, they are going to be the most obvious buys in this environment. And as the fear and dysphoria spreads, great quality companies with high growth that have been beaten down for reasons that are completely unrelated to the war, they could get even cheaper. This is the part of the playbook that separates basically amateurs from smart money. Wall Street doesn't just profit off the narrative trades during fear. They use broad-based fear to scoop up world-class assets at a massive discount while everybody else is too scared to look at anything. Makes sense. Now, if you're actively managing your stock portfolio, head over to stockscommunity.com/freedom to book your free 15-minute strategy call and chat about your portfolio and your goals. I'm currently offering this completely free 15-minute training as well on how I spot stocks before they go up. And I'll make you an offer at the end of this call to join our community if I think we're a good fit. It's a trial offer. One of our recent members went on to make thousands of dollars in a single day from learning these strategies. You can book this 100% free call at the link in the description below. Now, let's talk about some specific names. So AMD is one of the highest quality assets you could buy right now for what I think is really pennies on the dollar. Slight hyperbole, but AMD is one of the most important semiconductor companies on the planet, increasingly taking NVIDIA on competitively, and they just signed a massive deal to deploy 6 gigawatts of GPU capacity in the second half of 2026. Management is projecting a 60% compounded annual growth rate in its data center division over the next 5 years. It's huge. And the stock's trading at a forward PEG ratio of just 0.2. So anything under 1 is considered genuinely undervalued. If the market sells off further from here, only makes it a better opportunity. Salesforce, ticker CRM, is another one. The world's #1 CRM platform, over 40 billion in annual revenue, growing at 10% per year, massive free cash flow. Stocks roughly down 24% year to date. The whole software sector got hammered on fears that AI is going to make enterprise software obsolete. But the reality is Salesforce is actually leading the AI charge. Their own AI product just got over 500 million in annual recurring revenue, growing over 300% year over year. The company trades at roughly 10 times free cash flow. It's a steep discount to its large cap software peers. Microsoft is also trading well below its highs. It's arguably the safest large cap tech company in the world right now. Multiple independent fair value models have the stock trading anywhere between 25 to 35% below where it should be, based on discounted cash flow analysis. Company's AI embedded across its whole ecosystem, creating enormous switching costs, and it trades at roughly 28 times earnings with 20% earnings per share growth and a near zero debt balance sheet. So Meta is another one, nearly 4 billion monthly active users, over 60 billion annual free cash flow, roughly 100 billion in net cash on the balance sheet. To put that into context, Meta could go out and buy most mid-cap companies outright with its cash pile alone, and stocks sitting at roughly 20-25% below fair market value right now by, again, this discounted cash flow analysis. So Tom Lee specifically called out Mag 7 and software as leadership going forward, and that lines up exactly with the charts. Basically what this technical analysis I mentioned is talking about. Software is one of the leading groups that could finally bounce, and it appears pretty washed out. Now, before I get to the most interesting setup of all, I want to remind you, nothing in this video is financial advice. Do your own research. And if you haven't already, download my best 6 stocks to own in 2026 completely free at stockscommunity.com/free. Now, here's where it gets super interesting. There's a name setting up on the charts in a way that tells me something big could be coming, and it's in cybersecurity and IT infrastructure, which is exactly where smart money should be looking right now, given what's happening with the Strait of Hormuz. So everyone thinks they can code their own software now, but it's pretty hard still. Iran's not a stranger to using digital infrastructure as a weapon. Roughly 95% of the world's internet data traveled by undersea fiber optic cables. These cables are running through the Strait of Hormuz as a deliberate disruption. If they were disrupted, it would create crazy congestion, payment delays, latency spikes across the Middle East and Asia. Financial networks in the Gulf could see delays, and Amazon Web Services data center in the UAE was already shut down after a fire amid Iran strikes. So we're entering a phase of this conflict where land, air, and sea give way to information, cyber warfare. And the next move for Iran could be to target digital infrastructure. And the company I'm watching is one that sits right at the intersection of cybersecurity, enterprise security, and critical infrastructure protection. It's a name that Wall Street's been quietly accumulating. The chart is showing the kind of compression and coiling action that tends to precede a significant move to the upside. So I'm not going to drop the ticker quite yet because I want to make sure you understand the full setup, the context, the risk management, but think about what kind of company benefits most if cyber warfare escalates. Think enterprise, think infrastructure, think government contracts, the intersection of physical and digital security. So the ticker is Keys, Keysight Technology, an electronic measurement and cybersecurity solutions company. It's deeply defended in defense, telecommunications, digital infrastructure testing. It's quietly consolidating on the chart. And given the macro backdrop we just cut, the setup's definitely there. Now, let me bring this full circle. So there's a game that gets played every time the US goes to war. Wall Street knows the playbook. Retail, not really. And the result is always the same. Institutional money buys the fear. Retail sells into the fear. And retail watches from the sidelines as the market recovers without them. We've seen this time and time and time again. So we don't know how deep or aggressive this fear is embedded or where it goes from here. But at the end of the day, Wall Street always uses war to snap up assets because governments always do the same thing to fund these conflicts. They print money. And so it's up to you to make sure you're staying informed and positioned correctly. So if you found this valuable, smash that like button, subscribe to the channel, and hit the share button. Share it with somebody who needs to hear it, because the people who prepare themselves and do stay one step ahead of the everyday person will always come out ahead in the long run. And if you want to know how I spot stocks before they go up, book your completely free 15-minute strategy call at stockscommunity.com/freedom. The link's in the description below. Thank you for watching, and I will see you in the next one.